Hi, this is Kevin Berjou, Philly Mortgage Team, here to explain to you why, when the stocks are going down like a rocket and the market has been crashing for the past week or so, why are interest rates going up? So that's a very good question. And there's actually a threefold answer to this. So the first reason is something that's pretty simple. It's capacity. So normally when the rates start to trend down, they start to trend down in a slower manner. So you would see them as they have been, trending down from the mid fours to the low fours to the high threes, which is exactly what happened. However, last week, Wednesday, Thursday, and Friday, they dropped like a rocket till Monday morning, essentially. I locked somebody in at 2.875 with, and admittedly they were putting 40% down on a purchase of a single family house with great credit, but still, that was in the high twos. Now you're back up, if you look at bankrate.com, you're back up over 4% in the Philadelphia area, and that would give someone pause. Usually when stocks are doing bad, people have a flight to quality, so they buy bonds. The bond yields go down, and therefore the interest rates go down, and that's not happening. So again, the first issue is capacity. You had such a big influx in the amount of people who wanted to refinance over a very short period of time. Mortgage companies, banks could simply not handle it. You can't just hire and train 10,000 originators and processors and underwriters in that short a period of time. I mean, we all saw rates started to come down, and so many companies were actually ramping up and starting to hire more people, but that's a very big jump or a very big drop in the interest rate in a short amount of time and a huge influx. I think it was something like 77% of all the mortgages that were originated last week were refinances. So that's issue number one. You just can't ramp up that fast, and so the banks and mortgage companies all put brakes on it and said, listen, if we're going to do that, we're going to raise the interest rates because we're going to have to pay a premium to get to try and hire talent to come in and handle that capacity. So issue number two is something that many people aren't even thinking about because many people don't even know. There's something called an early payment default, an EPD. So when one mortgage company does a loan and then sells it to a servicer, they have an agreement with that servicer that says basically, okay, if this person refinances, doesn't make a payment, defaults within the first 6 payments, that they get their money back. So for an example, let's say that I originate a loan and I end up selling to a servicer. And that servicer pays me $8,000 for that loan, or the mortgage company I work for, $8,000 for that loan. If that loan that was originated at 4.25% 3 months ago, if that refinances, that's an EPD, that's an early payment default, which means now I owe that company I sold the loan to back the $8,000. But wait, it gets worse, because in originating that loan, I paid an originator, I paid a processor, I paid an underwriter, I paid for the appraisal, I paid for the credit reports. So the chances are that on that $8,000 payment that I got, I spent $5,000 or $6,000 in costs. So now I'm not only out, I have to pay back the $8,000, but I can't collect back the other $5,000 or $6,000 in costs. So now I'm out, $13,000, $14,000 for doing a loan. So that's a huge amount of money, and that's a huge risk in this type of marketplace. And in '08 and '09, it's one of the things that early payment defaults that put mortgage companies out of business overnight. They just couldn't handle the amount of the defaults, so they just closed doors. So that's the second reason. Both of those reasons are kind of easier to understand. The other is liquidity. So liquidity was set up and reiterated in recent laws, but set up in the late 20s and early 30s when we had a crash. One of the reasons we had that crash was because everybody wanted to take their money out of the bank. Now, here's how a bank makes money. A bank makes money by taking in your deposits. You get a CD from the bank, and they're going to pay you 0.5% or 1%. Well, they're going to lend that money out at 4%. So they're going to make that difference. They're going to make what they call the spread, which is great. So if I'm a bank, I want to get as much money in so I can lend it out and make that spread as possible. I'd even borrow that money at 2% to lend out to 4%. So what the Fed, and by the way, this is what the Fed lowers when they do lower rates. They lower the overnight federal funds rate. And what that is if a bank doesn't have that money, and they say, well, we want to lend it out, we have plenty of people want it, but we don't, we have to keep a 10% liquidity requirement. And they can normally borrow that from another bank and give them an asset to hold on to and say, okay, hey, we're going to let you hold on to these CDs or treasury bonds, lend us this money so we can lend it out and make money on it. It's just a temporary situation. We'll get more money in. And that's normally how the market works. So sometimes you could have a bank in Northeast Philadelphia that says, you know what, we've got plenty of money to lend. We don't have enough lenders. And you got a bank in Center City that has a ton of people that want to borrow, but they don't have enough money to lend. They'll borrow it from that bank in Northeast Philadelphia because there's maybe less development going on in that area or less demand. Well, with this advent of the refinances, everybody is looking for that money. So if everybody's looking for the money, where is it? Where are you going to borrow it? You need to borrow it from the Fed. So the Fed just, Steve Mnuchin, who was on, sorry, I have his picture behind me. Steve Mnuchin, who's the Secretary of the Treasury, was on CNBC, and Jim Cramer really hammered him. Jim's my idol, so I think he's terrific. You should listen to Mad Money if you can. But he just said we're going to have as much liquidity as possible. So those are all the reasons that the rates went up. I think next week you're going to start to see them come down. So if you started the process of refinancing because you thought you were getting 3.25 and went, oh geez, the rates are up over 4, keep going with the process. Keep going forward. The rates are going to come down. They're not going to drop down tremendously overnight, but they will start to come down again. We have the liquidity in the marketplace. They're going to have to resolve the EPD dilemma. Capacity is what it is, but as we work through the system, they will start to add capacity. So that's your, I'd like to say, Mortgage Minute. That was about 7 or 8 minutes, but it's a good explanation, I think. Please reach out to me with any questions. Kevin Bergeau, Philly Mortgage Team, 215-681-3587. Have a great weekend.